too much above that level, absolutely flat on the benchmark indices. Maneesh Dangi from Mosaic Investing and Research, a veteran of the market and macros, is here with us on the show. Maneesh, morning. This is Reema here. From the last time we spoke, yields have fallen. The US 10-year yield has fallen from levels of 5% down to 4.4%. Crude prices have fallen from a peak of 98%. What is the global macro environment looking like to you right now? What's the setup and therefore your outlook?
So, hey, Reema, I mean, it's correct that yields are sort of picking up cues from the US economy, which is sort of beginning to show signs of stress. Not yet there in terms of recession, but unemployment is starting to tick up, and at some point in time, a feedback loop will kick in where higher unemployment leads to losses in economy, which in turn leads to higher unemployment. So, I think from a rates standpoint, 6-12 months out, rates will be significantly lower in US. I guess China is sort of thawing here, plateauing, so to say, but not accelerating despite all the efforts. Europe has been steady state, and local economy is, from a consumption standpoint, is starting to hit a sort of wall. Whereas there is some sort of sign of capex revival in economy after very, very long. So that's a very, very big picture, global growth macro.
You said the US yields will be much lower from where they are right now, 6 to 8 months down the line. What are the levels, and are you anticipating a cut by the Fed next year, and if yes, the quantum?
Well, the markets are anticipating 2-3 cuts in 2024, and I wouldn't be surprised with these sort of cuts. Frankly, markets have been a funny place. They've actually moved from one extreme to another for the last 6-8 months, from anticipating many cuts early 2023 to many more hikes, and now, of course, expecting cuts. So bond markets are, at least in US, are sort of confused folks. But given the economy, given the unemployment rise, given certain rules which have already kicked in, SAM rule and such likes, it's very likely that US would experience would see rate cuts coming in 2024. Where would the rates be? Where would the rates be? Your question on US 10-year, I wouldn't be surprised if it's in 3 handles, somewhere near 3.5, 3.75.
This is by the end of 2024. US 10-year could be closer to 3.5%. A 12-month.
I think so.
Got it.
Okay. Maneesh, hi, good afternoon. So, for our viewer who's watching right now, perhaps he would want to know how he or she can capitalize on this situation, right? As the rate cuts begin in the US, perhaps in the second half of 2024, what does an investor in India here do? What are the sectors or perhaps even stocks that one can focus on?
So most adjacent to this view, of course, is long treasury trades. And fortunately in India too, for retail investors, there are fund houses offering US treasury 2 to 5 year and 5 to 10 year bonds. So perhaps, a small allocation there makes sense. Indian bonds, of course, because Indian business cycle is at different stage, long bonds don't make sense much. But 2 to 5 year bonds, a high carry, credit space looks very attractive in India, and rather the cheapest part in the Indian asset basket. So that's what investors could do. Purely from equity standpoint, given that you're sort of staring at 2 major risks: one, US recession, and second, local politics and potential and upset relative to market expectations, I guess an underweight on equity is what I would suggest for Indian investors.
Underweight equities?
Yes.
So when you talk about underweight equities, I mean, this is a market that is, 2% away from all-time highs, right? So there's also this FOMO factor that people who, perhaps retail investors who haven't participated, they generally come towards the end of the rally. Do you think that's the phase, and are you cautious? Are you advising them to be cautious on equities now?
So look, from a wallet size point of view, this FOMO has already played out since 2020, not just in India, but pretty much every major economy and major market that we can think of. So in some sense, retail investors' participation in equity market is pretty significant already. As a matter of fact, in last 2 years, the broad indices haven't done well anywhere in the world, including in India. You could always call markets at top because it's a real asset. Inflation would drive markets higher and higher every year. It's just that how I assess and what everyone should think of market is how much risk premium you're getting over bonds, and that's negative for last 2 years as far as broad markets are concerned.
Are you underweight on Indian equities across various sectors? What's the call from the Reserve Bank of India for 2024? And banks, everyone's consensus, it's a consensus bullish call for most of the investors. Where do you stand on banks? Because they typically do better when the rates are going up.
So a couple of points here, since many questions here. One is the fundamental tenet of investing in rate cut environment is to be long duration. Banks tend to be short duration assets. In some sense, they are cash assets, so to say. So to that extent, banks, despite, of course, all the favorable tailwinds in India, generally should underperform pretty much across the world because they are short duration assets. What benefits, of course, long rates is lower rates is actually high duration assets like tech or anything whose cash flows are out in the future and the growth is high. So I guess that part should do well. From RBI standpoint, RBI is pretty hawkish right now. Since 2021, perhaps more hawkish than ever relative to where the macro is, and I would assume they're not very comfortable with the sort of pace of growth you're seeing in personal loan growth and generally credit growth. So I guess RBI is trying to sort of tame financial markets. You heard, Governor talk of how one should be sort of not be exuberant and be prudent in terms of lenders. So I guess, from a local policy standpoint, there is a bit of, you will have an obstinate RBI and fiscal policy at margin.
Okay, all right. We will end this discussion on that note. Thanks a lot for joining in. Let's take a short break.